Hi there, welcome to Kneppy Invest and welcome to my weekly update video where I go through interesting announcements released from companies during the week. Sometimes I do standalone videos on the more impactful announcements, and I did that for Areas Resources and Mesoblast. For those who don't know, Mesoblast share price fell 57% on Friday, August the 4th. Now, before we have a look at interesting announcements, I'm going to go through some interesting things, articles, tweets that I did see during the week. Now, we did see retail numbers come out on the 28th of July. And to be honest with you, this is for June 2023, of the quarter anyway. And I didn't really mention this on the previous video, but I thought it's a good idea to go through this because retail numbers are down, fell 0.8% month on month. Rose 2.3% compared with June 2022. And I really like the Australian Bureau of Statistics. You got a lot of information, not only on retail sales, but also different sectors of the retail area. So they have a monthly turnover here, and then below this, they have a quarterly turnover, and quarterly is down 1.4%. Last time it was down, it was way back in the September quarter 2021. So it was only negative once that year. More than likely, that would have been lockdown affected, where you can't say that this time. This is more likely a function of rising interest rates. And the other thing I'm paying close attention to is unemployment. If we start to see unemployment rising, particularly in America, and the reason unemployment rising in America is important is because they have a little committee. So they don't go based off a GDP falling 2 quarters in a row. They have a committee who decides whether the United States is in a recession. And one of the things they will look at is unemployment, because unemployment is very important. If unemployment stays really low, like it is right now, more than likely there won't be any recession, official recession anyway. And if they do see unemployment start rising, that will be a sign that the United States has moved into recession officially. There are some people out there who think it's been a recession for a while. There's also some other people out there who think there won't be a recession at all either, even though all the evidence suggests otherwise. And I'm one of those people. I think there's a chance we don't go in recession because of employment, because there is a potential we just have enough people out there for all the jobs. And the reason behind that is a lack of birth rates or decreasing birth rates, and also a plethora of baby boomers and the like actually have retired. And we don't have enough youngsters, teenagers coming through to replace all those retired baby boomers. Anyway, it's just a possibility. So the other thing I have here is your monthly turnover by industry. I like to look at this all the time, see which parts of the retail sector are struggling. So the only sector, whatever you want to call it, industry that was not negatively affected was food retail, up 0.1%. So that's more than likely Woolworths, Coles, that sort of thing, which is understandable. That's very defensive. We need to eat. If you don't need to eat, please can you tell me how you don't have to eat? Household goods retailing only down 0.1%. Cafes, restaurants, takeaways, food services down 0.3%. But then look at the big sectors, the big industry who were down big. Clothing, footwear, personal accessory retailing down 2.2%. Other retailing down 2.2%. Department stores down 5%. People aren't going to Myers anymore. So Myers share price has fallen a lot. They did really well for a while, but it's fallen a lot. They also have a seasonally adjusted, I don't know what that is. And here's the monthly turnover by state. So things are not looking good in the 3 biggest states, New South Wales, Victoria, Queensland. Things have moved up in Western Australia, Tasmania, Northern Territory. No idea why. And they go through all the industries. I probably prefer it to be called sectors of the retail. So have a look at that. ABS is a really good website. So I do recommend having a look at that. Now on to some interesting articles. This is not from the Sydney Morning Herald, but Brisbane Times, but they are owned by the same Fairfax. And I can actually go to Brisbane Times and have a look at the articles for free sometimes, because Sydney Morning Herald is, you have to pay for it. I think you get 10 articles for free per month, but I go through that within the first day or so. This is interesting. The financial, I'm actually just going to move my video over to this side. So I saw the title of this particular article and I was really interested to see what is the financial heroin product. Not that I'm interested in heroin or anything like that, but what is this product they're talking about? And they're talking about contracts for difference, CFDs. I have heard about contract for differences or difference, and the little I know about CFDs is enough for me not to get involved in them whatsoever because of the massive risk you do have. And they talk about how a lot of retail investors get caught in by this and they lose a lot of money. And it actually says here in the second paragraph or second sentence, for an investor, a win represents a massive high, but if you lose, withdrawal is financially paid for. And I don't want to do that. The most vulnerable are unsophisticated retail investors. I hate the word sophisticated and unsophisticated, but anyway, retail investors, 77% of which will lose money, according to a warning on the website of broker Atturra. That firm was sued by the court regulator on Thursday over alleged deficiencies in its sales pitch to tens of thousands of mums and dads. So if you do use CFDs, I'd love to hear your opinion on them. I have no interest in CFDs at all. Another really interesting article during the week from Ross Gittins in relation to productivity. New South Wales Treasury kicks off the new realism. Productivity won't be speeding up. And I really hate how workers are blamed for decreasing productivity. It's not up to the workers to increase productivity. It's up to companies to increase productivity. And thankfully, Ross Gittins talks about this. So a business or a whole economy improves its productivity when it finds ways to produce more outputs of goods and services with the same imports of raw materials, labor, and physical capital. Sounds a great idea, but how is it possible? Short answer, advances in technology. That's how you increase productivity. Workers become more productive when they're given tools and machines, better tools and machines to work with. And unfortunately, over the past 30 to 40 years, businesses in Australia and probably around the world have been incentivized not to increase their technology, not to improve their technology, because their profits have been increasing at a greater rate than the wages. So they get no incentive to improve their technology. And we have seen time and time again over history that the best way to improve productivity, to improve technology, is you have to give the incentive to the businesses, to the companies. And the best way to do that is increase wages. Because when the company sees increasing wages, increasing costs, they go, we have to find a way to improve their technology to get more out of workers. So this is the reason why productivity is just stalling right now. The other reason productivity is stalling is we have gone from a manufacturing-based country to a services-based country. And it's really hard to increase your services. Just go to a hairdresser's. They can only cut hair at a certain rate. They can't improve significantly how much they can cut hair. So services-based economy is going to be affected when it comes to productivity. There's only so much we can improve productivity in those sort of economies. So the best way to improve productivity is to increase technology. And unfortunately, businesses aren't incentivized to do that right now. We need to increase wages, give them an incentive. So I'm really happy that Ross Gittins started to talk about that. It's not up to us, the workers, it's up to the companies and really the government as well. Another thing I'll talk about here is IPOs. This is from Livewire. There are 9 upcoming Australian IPOs looking to raise blah, blah, blah. But the most interesting thing is this little chart or graph, whatever you want to call it here. And in fact, I should zoom in on this, because there has been a dearth of IPOs recently, an absolute dearth. So they go through the IPO activity by quarter since 2019, and there was a rush of IPOs, a massive amount of IPOs in late 2020 into 2021. In fact, I think the financial year 21 IPOs was a record, and we might have a record low this year. There are no companies wanting to IPO list on the ASX, and this is probably true also throughout the world. So there are a few companies wanting to list, but a lot of those companies are mining companies. That's the one thing I've noticed. A lot of, maybe not a lot, but the majority of companies listing right now are mining companies. It's funny here. The first company to mention, Abacus Storage King, is not really an IPO. It's a spin out from Abacus Property. That's what I have heard, and what I ever heard, it makes sense. I think that's already happened. Anyway, so we just need, I love IPOs, and I would like a much better rate of IPOs on the ASX. I loved late 2020 to 2021. So many companies IPO'd, and I have actually bought quite a few of those companies. A tweet from Don Johnson, probably not that Don Johnson. This is someone else, probably a fairly common name, an internet enigma, chief economist, for who? I have no idea. The recession model developed by Harvard PhD Atturra Estrella has the odds of recession in the next 12 months between July 23 and July 24 at 99.82%. That's pretty big odds. In fact, this recession probability over time, if you look at it, does pretty well. It has picked all the recessions. So just before we go into recession, the probability spikes up. And so this is the highest recession probability since 1980 or the early 1980s anyway. So again, a lot of people think we're going to go into recession. The signs are all there. But on the other hand, this is a tweet from, a retweet, I think, from, a tweet from Rudy Villepick Van Dyke. Oxford Economics. The number of forecasters that are ditching a recession scenario for one with a soft landing is growing, but we're not ready to make this change. Our forecast is for a mild recession to start in Q4, but risks are that it could be delayed until next year. It's really interesting because before the GFC, everyone was thinking it was going to be a soft landing. And I've heard this time and time again, that every time we are approaching a recession or possible recession, everyone thinks it's going to be a soft landing. And I keep hearing that as well. It's going to be a soft landing. And maybe I think that as well. I think it's also possible we won't go into recession at all, but I do think this time it's different. I probably would warn people thinking that this time it's different. That's the most dangerous few words. This time it's different. Most dangerous 4 words to think that this time is going to be different because, again, history doesn't repeat, but it often does rhyme. But there are differences right now in the world, and it has to come with population growth and people just not wanting to have babies. I'm one of those people. Tweet from Brian Ferroldi, why I don't use stop loss orders. This is ridiculous. If you are a long-term investor or if you want to buy a company, just hold it for as long as possible. Yeah, you wouldn't use stop losses. And I would expect that Brian Ferroldi is a long-term investor. But when you are trading for the short term, yeah, stop losses are quite important. I have manual stop losses. So I know the price I want to get out. And if I see the share price going below that, I will sell out. So I don't put it automatically in there. But I think this is, yeah, I do have a problem with this. And I'm just going to go through some of the comments, see if someone mentions that. The chart is misleading because it implies that once a stop loss is hit, it's impossible to buy back in. Yeah, that's actually quite true. One can always buy back in. But psychology suggests a lot of people, when they sell out of a company, they have this mindset that you shouldn't buy back in. And I actually understand that psychology. I don't do it. I will buy back in if I sell out, if I've made a mistake. Yeah, this one here, during the flash crash in 2010, some folks with stop loss ended up selling at deep discounts and losing money. Again, I don't put in stop losses automatically. Buy and never sell, winner. Yep, so that's a long-term investor. No one's saying, no one's really saying anything against it. Oh, wait there. Good thing you don't trade when investing with a long-term mindset. There's no need for a stop loss. You're also not levered. I like this person. The wise shilling. Good thing you don't trade. Yeah, I believe stop losses when you trade, but not when you're investing for the long term. Another one here. Your visual fails miserably in Risk Management 101. Stop losses buy. Yeah, there's also the scenario when your stop loss is hit and the share price keeps on falling. So there's also that scenario as well. Enron, perfect example. If your stop loss was hit then, you would have sold out. And if you didn't believe in stop losses, the share price kept on falling and falling and falling until it became zero. So there are benefits of stop losses, but I wouldn't probably think Enron was a high quality company. Anyway, if you do use stop losses, tell me. I'd love to know who uses stop losses out there. Oh, Amazon. This is just me loving, because I am a shareholder of Amazon. Second quarter earnings per share almost double the forecast earnings. Revenue up by or more than $3 billion over estimated or the forecast revenue. So a really good quarter for Amazon. Haven't gone through the briefing or anything like that. Why it was a really good quarter. Share price rose something like 8%, if I remember correctly. I could be completely mistaken there. Amazon. Fun enough, at the same time, Apple released disappointing results and their share price fell. So if we look at the daily chart, this is 1 hourly chart. Share price rose 8.3%. It was actually up higher. Nice chart for Amazon. It has turned positive. While what's the other one? Apple. Alphabet also released pretty good results recently. Apple down 4.8%. Now it's below $3 trillion. Apple is now below $3 trillion. I said that right. So a great quarter from Amazon. I said once before, not in this channel, but to someone I know, that if there was a company that's going to take over the world, I would think it's going to be Amazon. I've changed my opinion now. I think there's a few possibilities of companies taking over the world. Amazon is one. Apple behind, Microsoft, Google, or Alphabet. Tesla won't overtake the world. Okay, from Jesse Felder. I can't remember what this tweet's about, but I saved it for some reason. The US is running a scandalous 1.5 trillion deficit with unemployment at 3.6%. I know what he's talking about right here. So when you have really good employment, you should not be increasing your deficit. So this is a problem a lot of governments have, is when times are good, you should be going into surplus, building up that bank for when times are bad. But it seems like when times are good, they completely increase their spending, that sort of thing. So I am concerned about how much debt there is out there. I have heard someone say that we never used to go into debt. Humans never wanted to go into too much debt. And this massive increase in debt has been a recent thing in history. I'm not sure about that. I'm not sure if I believe that person, but anyway. Oh, and this is just the Sydney Morning Herald. I could not actually, they wanted me to subscribe. I'm not going to subscribe. Sorry, Sydney Morning Herald. Now on to some of the interesting announcements during the week. We are in August, which is reporting season. We started to see companies release their full year or half year results. And the first company I'm going to talk about is Corp. Usually it's one of the first companies to release their full year results or half year results, but not the first. Corvus is the first, KOV. Corvus released their results about a week before August started. Anyway, so Credit Corp released their results on the 1st of August. So they released a media release, results presentation, and dividend announcements. But the most important announcement here is the annual report, and it was not marked sensitive for some reason. So let's have a look at the annual report. Actually, I should have opened this up well before I wanted to talk about it. Because it's going to take ages. So let's have a look at the media release first. So typically I will either have a look at the media release first or the results. And the reason I'm opening up the annual report is because I actually did mention in the bottom of the media release should be in conjunction or read in conjunction with the Appendix 4E. So in the 4E is usually the financial statements, but they're mentioned in this particular document that Section 3, Section 4, Section 5, Section 6, please refer to the 2023 annual report. So that's why I want to open up the annual report. And typically in the annual report, the first thing when company releases financial results, the first thing I always look at is the cash flow statement and then work my way back. But it's usually found in the middle somewhere. We're going through all the director stuff, remuneration, that sort of thing. And here we go, auditors. So first thing I always have a look at is the cash flow statement. And here it is, this last financial statement. Now, I have no interest in Credit Corp. These sort of companies I just don't really understand all that much. So I don't have much interest in this company. And it's really interesting that if you have a look at the cash flows from operating activities before changes in operating assets, this company was operating cash flow positive. Receipts to customers up a little bit, but payments and suppliers, employers up even more than that increase in receipts, which probably means this company was not profitable. Well, I shouldn't say that. That the company decreased their profit in the year, and that's exactly what happened. The only reason I said that is because I knew they had a decrease in profit. But there's also a changes in operating assets arising from cash flow movements. So they spent $150 million on the net funding of consumer loans, $320.2 million on the acquisition of purchased debt ledgers. So they spent $470 million on that, which means this company was operating cash flow negative by $84 million. Last year, they're operating cash flow negative by $100 million. So that did raise a little bit of a red flag that they were operating cash flow negative by almost $100 million 2 years in a row, which means their borrowings more than likely has increased and definitely has increased by $180 million in the past year. They also paid a dividend, that sort of thing. So let's have a look at their, and then I go through the balance sheet, profit and loss statement, but I'm not going to go through that in this video. And then I usually have a look at the outlook and guidance. This is the most important part, in my opinion, of the results. I want to know what the management is thinking about the future, and their thoughts on the future can have a significant impact on the price. In this case, because the company's profit fell, I think there was a bit of weakness in the share price. Now, their outlook actually does mention a couple of things here that were really interesting, I think. If I can find them, more than likely I won't be able to find them. Yeah, so investment is expected to moderate in financial year 24. This should result in significant free cash flow and reduced net borrowings. So my red flag that was raised when I looked at the cash flow statement probably was a little bit reduced when I read that little statement in the outlook and guidance. They also gave some guidance for financial year 24. So NPAT between 90 and 100 million. What was that profit for this year? I can totally forget already. 91.3 million, fell by 5% over the previous year. So 91.3 million this year. Next year, they expect it to be between 90 and 100 million. So it could fall again. Possibly it's going to rise, probably more likely it's going to rise. But the share price in the market didn't like it. Probably should say the market didn't like it. Share price fell by something like 12%. Let's have a look. 12.6%. And kept on falling the next 3 days. So this is the daily chart for Credit Corp. It's been under pressure since the start of 2022. Share price got as high as $36. Jeez. Now, if you look at the weekly chart, I'm not that excited about this company. Beautiful uptrend in share price from 2010 all the way through to 2020. I think this company really struggled during the GFC just based off the chart. I wasn't following this company at all. There was 1 week here where the share price fell almost 50%. And another week where the share price fell 77%, the week of the 11th of February 2008. But that was near the bottom. You could have bought Credit Corp shares less than 50 cents back in 2009. And then the share price was in a beautiful uptrend. Probably this company is much stronger, healthier right now. The share price is not really doing anything. Not only that, there's a nice little support level around $16. Not only that, there's a nice little resistance level at or just under $24. So the previous high we saw in February, share price hit that level, pulled back, and the share price hit $24 recently and then pulled back. In fact, it hit $24 the day before the release of the results. And with this pullback in the share price, sentiment probably shifted from positive based off the share price movement over the past month or 2 months, now to more neutral, possibly even negative. High volume on the day they released their results as well. So if you do or are a shareholder of this company, love to hear your opinion on Credit Corp because I don't follow this company or too much. Now on to a smaller company that lends stuff, MoneyMe. This company released a financial fourth quarter 23 trading update. Now this company, I'm pretty sure they lend money to probably SMEs and that sort of thing. I actually have no idea. You can read what they do. Oh, no, they don't. Oh, there it is. About MoneyMe is a leading Australia disruptor using technology to become the #1 challenger to the major banks. That tells me nothing what they do. Sort of, well, it really doesn't tell me anything they do. So they want to become a bank. That's what it says there, but I don't think they want to become a bank. So they do lend money. And these companies have been under lots and lots of pressure over the past year and a half. You better say that when we look at the chart because the share price of this company has fallen by 98%. If I remember correctly. Now, I'm not going to go into too much depth in regards to the quarter update. Gross revenue up greater than 230 million, but it's interesting here, they mentioned beating financial year 23 guidance. So in a way, this was a revenue upgrade. Previous guidance was upwards of 220 million and revenue up 60% from financial year 22. And there was an initial really good reaction from the market. So let's have a look at the chart for MoneyMe. It's going to look ugly. Actually, what I should do is just get rid of this one. Even then, just maybe I won't. Maybe I'll have a look at the hourly chart. Yeah, let's have a look at the hourly chart. So when they released this announcement, in the first hour, the share price rose 6%. In the second hour, the share price fell 6%. So there was a lot of selling coming in. And the reason there's a lot of selling coming in, just look at the chart. This is like the most beautiful downtrend you will ever see in the share price of a Cardi. There was some bullishness back in January 2023. Share price rallied a lot. That was sort of, the company was announced they were in profit or something like that, if I remember correctly. I could be completely mistaken. Share price just keeps on falling. Then they announced a really discounted capital raising because they made probably a foolish acquisition and they had to fund that acquisition or something like that. But if you look at the weekly chart, share price of this company has fallen significantly over the past few years. Share price reached a high of $2.48 in July 2021. So 2 years ago, share price has in 2 years, the share price has fallen from $2.50 to 6.7 cents. Now, understanding that, and this company IPO'd on the ASX just before COVID-19 financial panic. But I'm going to say this space is starting to look interesting, and there are possible opportunities because the market cap of this company is something like $50 million. So there is an opportunity here, possible opportunities. But my main concern around this company is if we do go into a significant recession, a prolonged significant recession, I think a few of these sort of companies, and they're all suffering, a few of these sort of companies more than likely won't make it. They won't last. I think that's what the market is thinking right now. But if they do make it, I think this could be a possible opportunity. So I'm going to say about MoneyMe, I would not be buying MoneyMe shares right yet. But maybe you're more of a risk taker than I am. Baby Bunting. Another company who has been absolutely hammered by the market. They released a financial year 23 full-year results update. Now, I looked at this and went, nah, whatever. I wasn't excited about this, but I can be wrong. So sales up 1.7%, but they have increased their stores. So the thing I like to look at is comparable store sales. So if you didn't increase the stores, what would the sales be like? And sales down 3.6%. Gross profit down to 37.4%, so decreasing margins. Profit down to 14.5, down 51%. Statutory profit, 53 weeks, down 50% to 9.9 million. So straight away, just by looking at that table, ooh, this looks negative. Of course, it's also if these numbers are better than expected. And in the statement just below that, they mention here, the unaudited pro forma profit result is towards the upper end of the financial year 23 guidance. So this wasn't or not a profit downgrade. In fact, because it's towards the upper end of the financial year 23 guidance, some people might say this is a slight profit upgrade. Now, they also talk about recycling cycling positive 3.3%. I sort of gave up reading the commentary because it's really hard to compare the results of these companies because of what's happened over the last 3 years. But the most important thing when it comes to Baby Bunting is how did the market react? And the market loved it, absolutely loved it. So we won't look at the weekly chart. Let's have a look at the daily chart for Baby Bunting. Share price increased 21%. Now, the share price has stayed at these levels going sideways the last 3 trading days, which is exciting. And I've decided to take a small position in Baby Bunting. So you can see here, really nice buying in the first hour upon release of this announcement. And the share price hasn't really plunged, so not a lot of selling, even though there has been overall weakness in the market. This could be a turnaround story. So I've taken a small position in Baby Bunting, just believing the market. Market is saying something here. I'm not sure. I'm unconvinced, but I am just following what the market is thinking because the market, overall, the market is much smarter than I am. Much smarter. Much smarter. 29 metals. So they have a mine, Capricorn Copper, absolutely flooded in March. It's near Mount Isa. And they just mentioned here that it's progressing to plan. Restarting or recovery of operations is progressing to plan with the recommencement of mining in Mammoth and Greenstone and mineral processing operations this morning. So that's exciting for 29Metals. However, there was an initial reaction, nice initial reaction from the market. Share price up 15% in that first hour. And actually the second hour, because share price was only up 3%. Nice buying, and then has been selling. Share price has retreated. So if you look at the daily chart, share price still in the downtrend. Doesn't look as exciting when you look at the daily chart. In fact, I didn't show you the daily chart for Baby Bunting. And the one concern I do have for Baby Bunting is that the downtrend has not stopped. It's still in a downtrend. And the reason is that share price has just been falling and falling and falling and falling. Really, it's been a downtrend since end of 2021 when the share price was about $5.50. And I think there's a lot of shareholders in Baby Bunting who just want to get out. And whenever the share price rises like it did a few days ago on the back of this announcement, there will be resistance. The best way to get through that resistance is for the share price to go sideways, so those shareholders become bored and eventually they just give up and sell out, or the company just keeps on releasing really good news, really good financial news. And this possibly is the first piece of positive financial news from Baby Bunting. And if we look at the 29Metals chart, same sort of thing. Share price has been a downtrend for a while, falling all the way from over $3 back in 2022 down to 78.5 cents. Share price possibly has been consolidating over the past 2.5 months. So that's a good sign. Possible sign the bottom, just possible. Possible. That's what I'm saying. Possible the bottom has been reached. But the only way I would possibly buy 29Metals is based off the hourly chart. But I need to see the share price rebound from where it is right now, because there has been a little bit of selling coming in. TPG. So what happened to TPG? I think there was a potential buying of some of their assets. TPG Telecom response to media article. Now I remember, Vocus wants to buy their TPG's non-mobile fiber assets. So Vocus is no longer on the ASX. So they've made an indicative, highly conditional, non-binding offer to acquire certain of TPG's enterprise, government, and wholesale assets, blah, 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 for approximately $6.3 billion. The market cap of TPG is $10.2 billion. So this company could be flush with cash. So how do you think the market reacted to these particular rumors, I suppose? No, actually not rumors. This was confirmed by TPG. Of course, the market absolutely loved it. Share price up on the day by 11.6%. A little bit of selling coming in, and the share price has moved above the downtrend line, but it did that back in August last year. So possibly, just possibly, the downtrend in TPG's share price has come to an end, and that downtrend has been going on ever since 2020. It's just share price of TPG just keeps on dropping and dropping and dropping. Maybe this is the end of the downtrend for TPG. Don't hold your breath, though. Now on to a company that I've done no research on, a recent IPO, Atturra, share price down 3.4%. Probably noticed there's not a lot of buyers, not a lot of sellers, so illiquidly traded. So I do have a look at the trade history, and there is trades most of the day. So I wouldn't define this company as being illiquidly traded, but the experts on the call would. They would stay away from this company. But in saying that, they did release a financial year 23 results date and preliminary results update. And this company has a market cap, I think, 200 million or just above 200 million. According to ComSec, it's 222 million. And this looks pretty good. I don't even know what this company does. I'm pretty sure they're a software company. ASX-listed technology business providing a range of enterprise advisory, consulting, and IT services and solutions with a focus on local government, blah, blah, blah. Anyway, revenue up 30%. EBIT up 30%. Underlying earnings before interest, that's EBITDA, in the range of 28.8 to 21.1 million. This company is profitable. Probably just want to wait to actually read their financial year results, cash flow, that sort of thing. But this looks promising. So this is another company that's recently, not another company, it's, what was the trigger code? ATA. It listed on the ASX, I'm thinking 1 year ago. Yeah, 1 year ago. And over well, since it's listed, the share price has gone up. So this is a good start. When you see a chart like this for a company as IPO, that means there is some substance to this company. I do have a watch list with all the IPOs over the past few years, and 90% of the companies that have listed on the ASX share price have dropped significantly since they listed. This is one of the exceptions. So I'm surprised I haven't done any research on this company because it's been listed for more than a year. Has been struggling recently, but when the company did release this announcement, share price did rise 8%. If you see the share price getting above $1.08, actually $1.05, that would be an all-time high. That would be exciting. So anyway, possible future video for Atturra. Actually, I won't say possible. More than likely, I will do a video on this company. On to, I don't have to talk about Aries because I've already done that. On to Symbio. So this is really interesting. So there was a possible takeover of Symbio by Superloop. Symbio receives acquisition proposal, and so it's a possible takeover. What I completely missed when I read this is I did not read Superloop's announcement, because Superloop's announcement says proposal to acquire Symbio and financial year 23 earnings upgrade. I always look for that bit of wording, but I sort of missed that because it was lumped in with the acquisition of Symbio. So this is a profit upgrade from Superloop, and I'm not a shareholder. I've been following this company for a long time. I've been waiting for some good signs from this company, and I believe they should have separated the two announcements. They should have really focused on an earnings upgrade. That's the most powerful type of announcement. So what type of earnings upgrade? Is it EBITDA, which I don't like EBITDA. It's actually underlying EBITDA. Again, I don't like underlying EBITDA. It's likely to be $37 million. Previous guidance was for it to be between 33 and 36. So this is a profit upgrade. They should have really focused on this because the market was like ho-hum. No, it was like, whatever. Whoops, that's the wrong trigger. Market was like, whatever. You're making the acquisition of a company that's not growing at all. You can just see that in the share price. Share price did nothing on the day. Typically, when a share price or company releases profit upgrade, share price booms higher. It didn't happen for Superloop. And on the flip side, if you take a look at Symbio, which used to be MyNetPhone, I think it was MyNetPhone. Have a look at the 1 hourly chart. This is a beautiful looking chart for Symbio, and I did put this onto my my trading watch list because the share price broke above an isolated resistance level at $2.20, stayed above it for a while, and then the company released this by takeover, and the share price moved up by quite a bit. So this would have been, if I did take a position, this would have been an automatic sell as soon as it opened on the day where they announced this acquisition. So a beautiful chart when you look at the 1 hourly chart. Even the daily chart looks pretty nice as well. But I would not be buying Symbio right now. But look at the past. Share price has been as high as $7.50. So there is potential Superloop is buying nice assets with Symbio. Anyway, Superloop and Symbio, and then actually Link. Forget what Link's releases financial year results or preliminary results, an update on investments. I did not have a look at this at all. So usually when they do release preliminary updates, financial update results, whatever, there's going to be a table in there. There should be a table, and Link have that here. So revenue up 4.5%, and it's actually higher than guidance. Operating EBITDA up 8.3%, right in the guidance. Operating EBIT up 15.7%, higher than guidance. Possible they could have said this is a profit upgrade. They should have said that. They should just do the positive. This is a profit upgrade based off operating EBIT. Operating net PAT ex PEXA 89.3 million, up 1.2%. So this is a profit upgrade. And I don't follow this company at all. I don't like the services at all. But the market didn't care. Well, look at that chart. This company has released really negative news over the past 2 years or so. There was a date, 30th of December, this company's share price dropped 40%, and we're seeing massive drops in share price. 20% on the 13th of September 2022. Possibly this is the end. Although the market didn't care. Share price kept on dropping. In fact, the share price dropped 3% when they announced this or released this announcement. I don't know. It sounded a lot positive to me when I looked at it just there. But what do I know? Next one is Downer. So I'm trading this right now because the share price has been an uptrend. And then they released an announcement called Financial Year 23 Guidance Achieved. Non-cash impairment charge. Ugh. So you don't know how market is going to react to stuff like non-cash impairment charges. They shouldn't react much to that at all. And when a company says their financial year 23 guidance has been achieved, that's not a downgrade. It's not an upgrade. So I don't know whether the market should have reacted to this positively or negatively. And in the end, it was sort of neutral reaction from the market. So Downer has been in a nice uptrend. Have a look at the daily chart. So I do have a stop loss at 420. So it's just above my stop loss. And the share price has been trending up. And the 1 hourly chart, we have seen a little bit of a dip in the share price. So I want to see a rally in the share price now. I want to see the share price get above $4.65. If the share price doesn't get above that level, say within the next 3 weeks, I'll just sell out of this trade. And hopefully I will be in profit. I am in profit now by about $90, so not a lot. And if the share price falls below $4.20, that would be a sell for me. So I just put a line. We'll go back to the hourly chart. And I'll just put a line in why I chose $4.20. Now, not $4.20 exactly, but there it is. And the reason I put it there is if you go back to July, you can see the share price was going sideways for about a month. So there would be a lot of supply sort of in this area. So the market knows if the share price falls to that level, there should be supply. So I would be very surprised if the share price falls below, say, $4.10. So probably $4.10 should be my stop loss for this company because that would be lower than the lows we saw on the 7th of July. Anyway, so I expect a rally in the share price because they didn't release any negative news. And yeah, anyway, wait and see what happens. Solvar. This used to be called Money 3, I believe. Market update and financial year 24 trading conditions on the 3rd of August. And I actually did write some notes here because let's have a look at the chart first and see. So this is the hourly chart. And when they released this announcement in the first hour, share price dropped 31%. So what do you think the market thought of the announcement? Yes. And the share price going sideways. Look at that massive volume, huge volume. And then we can see that in the daily chart as well. Huge volume. This is dwarfs the usual volume for this company. That's a negative announcement, a really negative announcement. Share price has been a downtrend. So the market wasn't liking this company anyway. Share price has fallen from $3.75 to $1.15. If you look at the weekly chart, I just want to know when the last time the share price was this low, apart from COVID-19. We have to go all the way back to 2016. Share price has been or was in an uptrend. So maybe there is some value at these prices. But when you see that sort of reaction from the market, that's not good news. So let's see why the market reacted really negatively to this. And I think the most important part of this announcement is the financial year 24 trading conditions. So they have announced that profit is going to be 47.6 million. So keep that number in mind. I'm just going to write it down. 47.6 million with dividends. So this is a legitimate company. Revenue increased 11.4% to 209.3. Earnings or EBITDA increased 11.9%. So let's not talk about the financial year 23 update. Let's look at the financial year 24 trading conditions because they did give us some guidance. And this is why the share price fell 30-odd%. So when they released this announcement, I didn't have a look at it. I actually only looked at this when I wrote down the ticker code, and then I had a look at this announcement just before I recorded this video. And I was going through going, why did the share price go down a lot? And then I get to right at the end of the announcement to this section right here. And this is why the market sold off. Financial year 24 net PAT or profit will be impacted by the 4-year cost of central banks rate rise cycle, increases in funding costs, blah, blah, blah. And so this is why their profit is going to be significantly hit in financial year 24. So they're just, explaining. before they give us the numbers. After adjusting for all these impacts, with EBITDA expected to remain consistent with financial year 23, the group anticipates a 4-year normalized profit of 24 to 30 million. So remember, profit for financial year 23 was 47.6 million. So there is potential. Profit could halve in financial year 24. They also mentioned here, management expects profitability to exceed historical levels beyond financial year 24. But the market isn't that forward-looking. The market only cares about financial year 24. This is why there was a massive sell-off. And this is why this is a possible opportunity to buy this company at really good value if you have a long-term horizon. So if you're thinking past financial year 24. So I have put what's this company called? Solvar onto my watch list just to see when this downtrend comes to an end and when the trend in the share price starts to shift to positive and the sentiment shifts as well. Okay, so Solvar. Next company, Shine Justice. I saw the share price of this company drop a lot, and it had to do with this J&J. This is a law company, if you don't know. J&J Ethicon Mesh class actions update. The class actions were settled for $300 million, subject to approval of the Federal Court of Australia, blah, blah, blah. And the reason I wanted to talk about Shine Justice is because the share price did something weird. So this is the hourly chart. If you look at the daily chart, share price actually dropped almost 10% on this announcement. Share price has really been struggling lately. I put a nice little support level right there at about 70 cents, and actually 60 cents, 62.5 cents. And yeah, downtrend. But I was surprised. Maybe the market was expecting something more. So Shine Justice, not the sort of company I would buy. I don't like these type of companies. Law companies, accounting companies. I just don't think services-based companies are good investments because they're reliant on humans. They're reliant on us. And to be honest with you, we're not as good as machinery and that sort of thing. We cost a lot of money. Humans cost a lot of money to employ. Whenever I see a company talk about how they've increased their staff, that's one of the first things they point out. That's a massive turnoff for me, which is really funny because we need people employed. But funny enough, people being employed is a turnoff. And I like to see automation, that sort of thing, because when I'm investing. Anyway, and not many people employed. Should I talk about Square? Or should I say Block? Ooh, share price down big. I just don't like... So Square or Block, whatever it's called, released their... down 5.8%. So they released their quarterly report on the 4th, which is the Friday. So market didn't like it, down 5.8%. And actually, there is one thing I want to talk about when it comes to Block. So actually, I did have a look at their cash flow statement because I like how American companies do their cash flow statements. It's a little bit different than Australian. So if I just find it here. So they do sort of reconciliation, the way we do reconciliation in the notes. So they start off, you can find it here it is. So they start off their cash flow statement with the loss or profit, and then they work their way backwards to get to the cash flow from operations. So they had a loss of $145 million in the 6 months ended 30th of June. So why did they have a massive loss, yet they were operating cash flow positive by $407 million? There's a big discrepancy between the two. And the main reason, or one of the main reasons, is share-based compensation. Almost $600 million in 6 months of share-based compensation. I hate share-based compensation. I understand why they do it, to give or incentivize employees, but $600 million of share-based compensation in 6 months. In a year, that's over $1 billion. And this is so common in these type of companies in America. And this is why the company was not operating cash flow positive. It's a real cost to shareholders and the company, and they don't have to pay. I'm not sure if it's over and above the pay for the employers. It's something extra, which will be ridiculous if it's maybe the employers don't get as much take-home pay and they get this share-based compensation. But $600 million of share-based compensation in 6 months, it's just, It's just a massive turn off. The other thing I noticed here is I forget where it is. This company does something with Bitcoin. I don't know what they do. Yeah, here it is. Bitcoin costs. So Bitcoin revenue, Bitcoin costs. So does this company trade Bitcoin, which is interesting. And majority of their revenue the last few years is through Bitcoin revenue. And by far the majority of their costs is Bitcoin costs. So I've not done any research on this company, but those are the two things I found interesting when it comes to block. I keep wanting to call it Square. Now on to Resmed, a bit of a cult stock on the ASX. Here, Rudy was already showed him one of the tweets when he talks about the best companies on the ASX is Resmed, CSL, Resmed, CSL, Resmed, Technology One, Resmed. Always talks about Resmed. You can see share price down 9.3%, so that should be dead giveaway. That upon the release of their fourth quarter results, the market didn't like it. Market did not like what Resmed released, down 9%. Not only that, Resmed had also listed in America, on the New York Stock Exchange, and the share price on the New York Stock Exchange fell 18.5%, which is way more negative than what happened in Australia, and that's way more bearish. If you look at the Resmed chart in Australia, it's not as bearish. In fact, there was a bit of buying during the day. Share price reached a low of $29.12 up to $30.70. More than likely, the reason why there was a lot of buying is because it's a cult stock. Fund managers love this company, really loves it. Talks about Resmed all the time, as I mentioned. Resmed. And then if you look at the weekly chart, share price of this company is just doing nothing over the past 2 years. Beautiful uptrend before that. But yeah, not a good quarter for a few reasons. Now, revenue increased by 23%, which is a good start. But gross margin contracted 210 basis points to 55%. So 55.8 to 57.1 to 55, and non-GAAP gross margins contracted as well. Income from operations increased 8%, operating cash flow of $237.4 million. So obviously the market didn't like it. And gross margins for the full year also went down. You want to see gross margins steady or increasing. So if the share price keeps on falling, like it has in America, Resmed, let's have a look at the weekly chart for Resmed in America. It looks way bearish. In fact, this is the first time ever, well, since 2011, the share price is now below most of the moving averages. So the bottom of the moving averages here, I think it's the 150-day moving average. I can actually tell you right now. 200 moving average. So the share price is now below the 200-day moving average. So a really bad day for Resmed. I still think it's a high-quality company, but I think it is overrated a little bit. And the reason it's overrated is because it is a cult stock, P ratio of almost above 35, and I don't think that's really justifiable based off their growth. So anyway, I could be completely wrong. Maybe that's justifiable. A little company called Cirrus Network. So I've already talked about I don't like companies that have a lot of staff paying a lot of money to employ people. And Cirrus Networks is one of those low-quality companies that has really good revenue. So let's have a look at they released their full year results. Which one should I'll bring up this one. This company has always had really good revenue, nice growth in revenue. For the year, this company had revenue of $112 million, up 8% on last year. Gross margins up 14%, $16 million. Adjusted EBITDA, $4.8 million. So nice numbers, nice increases from last year. But again, really low margins because they hire a lot of people. This is one of those companies that just talked about, we have increased our staff by 50 people, blah, blah, blah. Pretty sure they are a services-based company. We can actually have a look at their About section. Hopefully they have it here. About Cirrus, an innovative managed services and IT solutions provider. So the more work they win, the more people they have to employ. That's not what I want in a company, in my portfolio. I want the complete opposite. I want a company to, maybe not the complete opposite. I want a company to increase their work, but have the same staff in employment, but Cirrus Networks doesn't do that. Anyway, it's actually a pretty good year for Cirrus Networks, and the market is starting to like this company. But in saying that, the market, I think, agrees with me. You look at this weekly chart, it's just done nothing since 2015, just gone sideways. And there's been periods of time when the market likes this company and periods of time when it doesn't. But right now is a period of time when the market is starting to like this company, but it's gradually going up. The market cap of this company is something absurd, like $40 million. So just based off the market cap, $40 million, P ratio 39. Possible some value here, but I'm just concerned that they won't be able to continue this momentum in the future. And this could be as good as it gets for Cirrus Networks. Now on to Dicker Data. They also released some sort of trading update, a market update they called it, first half. So obviously they released the full year results in February. So let's have a look. So this is another company with really low margins. You can see that revenue of $1.6 billion, yet EBITDA is only $71 million, net profit before tax $54 million. That's okay. That's okay that this company has really low margins, just as long as they can slowly increase those margins and increase revenue over time. They should be able to increase their profit and EBITDA. So nice increase, 9.4% increase in revenue, 16.4% increase in EBITDA, 8% increase in net profit before tax. The only thing is, did they have any other guidance, previous guidance, and does it beat that previous guidance? Or is it down on that previous guidance? I haven't gone through this at all. And a way to find out, if you don't know, is just have a look at the market reaction. And based off the market reaction, share price in a downtrend. And based off the market reaction, nice volume, share price up 4.7%. So the market's sort of like this announcement, but share price is still in a downtrend. And I have this company on my watch list because I'm waiting for an end to the downtrend. Possibly this is it, just based off the 1 hourly chart, but still a lot of resistance moving forward. A lot of shareholders have bought in at higher prices. Now on to, I have no idea that there's a potential takeover by ANZ Group of Suncorp, something or other. Not the whole of Suncorp, but the, what's it called? The ACCC said, no, we don't want this to happen. So Suncorp today responded to the ACC's decision to deny authorization of the planned sale of Suncorp Bank to Australia and New Zealand Banking Group. And of course, Suncorp's disappointed, ANZ's disappointed, and the market was ho-hum. ANZ was up 0.5%. Suncorp was up 0.6%. Market didn't care about this at all. I thought the market would have reacted. So let's have a look at the charts for both these companies. I would assume Suncorp's in a beautiful uptrend. Oh, look at that. Okay. So even though the share price was up for the day, initially there was a bit of selling. So the share price actually opened at $13.60. And then the share price rose from $13.60 to $13.95. So initial negative reaction from the market, which is retail investors, by the way, and then pretty high volume as well. But the share price in a beautiful uptrend. But I just don't like these companies. Look at that daily chart. Last time the share price was these levels, $14 was, let's have a look at the weekly chart. Actually, it was not that long ago. I thought it was going to be longer than that. It was only 2018. But why would you buy a company? Look at that chart. Why would you buy a company like this? Share price before the GFC was significantly higher. Same with ANZ Bank. To me, these are not quality companies at all. Quality companies, you don't see charts like this over a 15-year period. Share price has done nothing over 15 years. And you just get a little bit of a dividend. And really, where's the growth going to come from? So low quality company. These are some of the biggest companies on the ASX, ANZ. And this is why individual investors like you and me should be able to beat the market, because these companies have like ANZ Bank, banking companies, ANZ, Westpac, NAB, maybe not Commonwealth Bank. But these companies are a large portion of the ASX and they're not growing at all. So this is why we should beat the market if we don't buy these companies and have them in our portfolio for the long term. And the last company I want to talk about is Chic. As you can see, share price up 28%. Why is the share price up 28%? Look what it's done in the last. Share price has increased. Low, trying to find the low. Low was 31.5 cents on the 17th of July. Share price has almost doubled in the past 3 weeks. But I still don't think the share price is an uptrend. So the reason why the market got excited about Chic was the sale of Evans and exiting EMEA, which is, I'm not even sure what EMEA is. That's Europe, Middle East, and Asia. That's what I'm assuming right now. Anyway, any numbers here? AK Retail Holdings will pay Chic a total cash consideration of £8 million. And yeah, nothing much. Market liked it. That's the most important thing. Would I take a position in Chic right now? I have put onto my watch list. And if we see, look at that chart. This is the weekly chart. Well, it's the Matterhorn pattern, which you find typically in technology stocks and apparently with Chic. Let's have a look at the daily chart. Based on the daily chart, you could say that the sentiment in this company is starting to shift positive. And I'd say if you look at the 1 hourly chart, it's looking interesting. I would probably prefer a pullback to say about 52.5 cents. Maybe if I see that, say 54 cents or so, just like we've seen in the last few days, there has been pullbacks. Maybe a little bit of a trade with Chic, just a trade, which could turn into a longer trade. It's really interesting. I was listening to a podcast the other day, and this was actually Oz Business Calls, and both people just said, no, we're out of the retail sector, discretionary retail sector. We're going to wait until the economy improves, and I think that's going to be way too late. You can't wait until the economy improves because the market will know beforehand when the economy should improve, and you'll see these companies' share price go nuts. And one of them actually said, we'll wait until the share price of these companies drop. So let's have a look at Nick Scali. So the share price of these companies are not dropping. Look at the daily chart. The share price of Nick Scali has rebounded really nice. So I think possibly the lows have been reached in these companies, and the lows possibly were over 1 year ago in June. Let's have a look at JB Hi-Fi. I don't think this company will drop all that much. It's going sideways. So I think the market is already pricing these companies maybe fairly. Now, if we go into a deep recession, that's another story. And there is possibility these companies will fall. But it's really interesting that we had two experts who are waiting for the share prices of these companies to drop significantly. And I think the drop has already happened, not with JB Hi-Fi, but with Chic, Baby Bunting, Adairs, those sort of companies. The lows have maybe already been reached, possibly. Anyway. That's all I want to talk about in this video. It's gone on for a while. It's 1:33 p.m. on Saturday. Geez. And if you have any questions, any thoughts about any companies I've mentioned in today's video, leave your thoughts in the comment section of this particular video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.